Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Friday, everybody. But it isn't Friday, is it? It's Saturday. And look, I got to admit, I took a day off yesterday. I didn't do anything. Okay. But I knew I had to come here and I knew I had to do 15 minutes for you because this was a great week for financial news. Tons of stuff happened, both good and bad, technically, but a lot of financial news. Okay. Honestly, I was kind of excited to do this yesterday. I just didn't do it. So my bad. Okay. I own it. My bad. But I promise you today's episode worth a listen. It's also worth a share. Okay, so buckle up, put your thinking caps on, and your listening ear mugs or muffs. Are they called muffs or mugs? Ear muffs. I think it's muffs. Why would you put mugs on your ear? I don't know. But today's quote of the day or word of the day, because we're actually doing a definition today, is fundamental and technical analysis. Okay, so I'm going to read Investopedia's description, and then I'm going to give you my professional money manager definition. Okay. So fundamental versus technical analysis and overview. There are two main schools of thought when evaluating investments and making trading decisions: fundamental analysis and technical analysis. While both aim to predict future price movements and identify profitable opportunities, they take very different approaches. Fundamental analysis examines an asset's intrinsic value by examining economic and financial factors, while technical analysis focuses solely on price action and chart patterns. Okay. So let me just read these key takeaways because I think they're good. Fundamental analysis evaluates securities by trying to measure their intrinsic value. Technical analysis focuses on statistical trends to the stock's price and volume over time. And both are loved and hated. So I'll tell you this right now. I use both, but I'm definitely a fundamentals guy. Okay. I'll give you my definition real quick. So fundamental analysis is, it's kind of like taking a screenshot of something. Okay, you're taking where it is right now, taking a mental picture of it, and you're assessing value to it. Whereas technical analysis is looking at something strictly by numbers over time. So that's why they use the word charts, right? So like technical analysis is for the chart heads. That's pretty much true, because all you're doing is looking at price movements or fluctuations or number changes in the technical analysis of a company or a stock or an ETF, an investment, etc. Whereas fundamental, I really like it because it is big picture. It is, where is the company going? Where is the company at? And what is the value right now? Is it an opportunity to invest? Is it in growth mode? Is it on its way down, etc.? Fundamentals is a really good job of that. One, because you're looking at who are the leaders, right? So who's the CEO, CFO, the C-suite execs? What is the goal, right? What is the goal of the company? And then where are they at as far as what they're actually doing? So we'll use a farming company. Do they own a lot of machines? Do they have a lot of debt on those machines? Do they own more land than their competitors, et cetera, et cetera? Those are like fundamental things. And that is where I choose to live. I love investing that way. It's been successful. And, knock on wood, hope it keeps being that way. And I've just found that charts, looking at the numbers, doesn't really, it only works if we're day trading. And I don't know a single successful day trader. Okay, a day trader is considered somebody who makes 5 trades in a 4-day period, I think or it's 4 trades in a 5-day period. It's either 4 and 5 or 5 and 4. I can't remember which one. But like I said, I don't know a single successful day trader. And there's also a reason why 95% of money managers, it's me included, okay, 77 included, in that 95%, or in this, not in the 95%, thank Jesus, but in this statistical analysis, 95% of money managers don't beat the stock market over a period of time. Okay. And the reason I wanted to make sure I did 15 minutes this week is because there was an article that came out that went over how stock markets do during wartime. Okay. We're in wartime right now. There's multiple wars going on. We're giving money to both wars. And we also have hurricanes all over the place. We have people dying in the in the Bible Belt and in the Southeast over here in America, and what are we doing, right? Like, how is the stock market still doing so well with all of these things going on? And I kind of wanted to read to you guys this article, and then we'll dive into how the market has reacted to. I mean, we'll go over different shocking events to the stock market, like things that shell shocked it, and how quickly it rebounded. Okay, and the reason I bring up the 95% don't beat the stock market is because those people who are trying to beat the stock market use technical analysis over fundamental analysis. And this is why I believe we have a superior investment philosophy than pretty much everybody else, is because we ride both waves. Okay, we're looking for fundamental companies. Okay, companies using fundamental analysis that we think are 10 baggers. Peter Lynch, my favorite money manager of all time, he had like a 30-year period of 25+% every year, or maybe it was on average, of return. Okay, there's almost no other fund manager with that kind of track record. He's got a bunch of books that are worth reading, worth listening to, but he calls them 10 baggers. Okay, you're not looking for a company to go up by 20% in 2 weeks. You want a company to 10x in 10 years. Okay, in 20 years. That's what you're looking for. So let me read this article real quick, and then we'll go over the different periods of time and how long or different events in time that took the stock market by storm, and how quickly it took to rebound and then to go above that. Okay. So this article, whoever did it, it's by Market Watch. Let me see. I got to give some credit here to Steve Goldstein. This amount of research is difficult. So I wanted to read it for you because it's really well done, and I'm excited about it. So, okay, let's start here. Buy to the sound of cannons and sell to the sound of trumpets was the purported quotation from Baron Nathan Rothschild during the Napoleonic Wars. That's kind of what oil traders did on Tuesday, with the light sweet crude contract jumping from the low $67 per barrel range when media reports said that Iran was about to send missiles to Israel, up to as high as $71.80 after Iran's mission to the United Nations said it was done for the day. But the U.S. stock market did not enjoy the ride, with the S&P 500 index at its worst falling 1.4% after Iran sent hundreds of ballistic missiles into Israel on concerns spiraling Middle Eastern violence could disrupt oil supplies. Adam Kobesi of Kobesi Letter broke down how stocks fared during wars in its social media thread. The initial stock market response, he says, drawing on LPL Financial's data. LPL is a broker-dealer, you guys. It's not great. The total average drawdown of the S&P 500 to these major events is 8.2%. But looking at it further, what really matters is if the economy is in a recession or not. The average 12-month gain when a war breaks out outside of a recession is 9.2%. The average 12-month loss when a war breaks out during one is 11.5%. Okay, so that's a huge swing, 9% up and 11.5% down. With the Atlanta Fed's GDP now estimating 2.5% third quarter growth, it is unlikely that the U.S. currently in a recession. I don't think we're in a recession. Looking at an even broader range of geopolitical events and stock market reactions, the market bottom typically takes 22 days with a recovery time of 47 days. I'm going to read that again. Looking at an even broader range of geopolitical events, meaning looking at a broader, other than war, we're looking at other things that tend to have a stark stock market reaction. The market bottom typically takes 22 days with a recovery time of 47 days. Of course, Middle East unrest is just one input into a whole host of unknowns right now. That includes the economy, interest rates, a U.S. port strike, which this article came out last Tuesday, so they don't know that port strike's already over, a U.S. port strike, and an election. Sum this all up and you have a very dynamic situation which largely depends on a recession outlook. He says, markets that have many different moving parts almost always come with severe volatility. Okay, very, very true. All right, so I wanted to read that, and then I wanted to... Hopefully you guys hear that. The range of these geopolitical events, 22 days to bottom out, 47 days to recover. So, and that's on average. Sometimes it's 1 day. Let me read some of these for you. Okay, so we have Pearl Harbor, okay, 12/7/1941. The 1 day change was a negative 3.8%. The total drawdown during that period is 19.8%. The bottom took 143 days, and the recovery took 307 days. So that, a little bit less than a year. JFK assassination, 11/22/1963. The worst 1 day after, negative 2.8%. Total drawdown 2.8%. The bottom took 1 day and the recovery took 1 day. Iraq's invasion of Kuwait, 8/2/1990. 1 day, after 1 day, the market went down 1.1%. The total drawdown was about 17%, with the bottom being 71 days after the event and the recovery taking 189 days. Also, just so you guys know, that recovery is from the event. Okay, so it's not nearly as bad as those numbers sound. Okay, now we have 9/11. 1 day, markets went down about 5%. The total drawdown was 11.6. The bottom took 11 days and recovery took 31. Okay, if you guys remember 9/11, that was a pretty crazy response. Let's look at the London bombing. I guess that's not really. Which one do we want? The Boston Marathon bombing. I guess we can do that. 4/15/2013. 1 day was negative 2.3, and the worst total drawdown was 3%. The bottom was 4 days after the event, and recovery was 15 days. And then we look at the Russia-Ukraine war, 2/17/22. 1 day, after 1 day, was down 2%. Total drawdown was 6.8%. The bottom took 13 days and a recovery took 23. Okay, there's some other noticeable events here that I wanted to talk about here. So, market stock. Where's the big one? The 6-day war is a big one. I mean, none of these are the actual days that we would care about, like 2008. I can tell you 2008 took about a year and a half to recover. Okay, so like 2009 is when it bottomed out, and then by 2011, it was already at new highs. Okay, we were already moving up. Again, I bring all of that up to tell you, it's hard to beat the market. Okay, the best investment, when we say the market, by the way, we're talking about the total U.S. Economy for most scenarios. When I use it, I'm talking about the S&P 500, which is the 500 largest companies in America. There is no better investment than American companies. There just isn't. Now, maybe for a period of time, there is. Okay, like India's had a really good year. Maybe for a 6-week period, India did better than the total stock market. But historically, there's no better investment. Okay, Warren Buffett's famous quote: "I can't tell you what the S&P 500 is going to be tomorrow, but I can tell you in 10 years it's going to be higher." The thought process behind that is that you're investing in the 500 largest companies in America, the freest country in the world, where essentially capitalism is the goal. Okay, now obviously you can have your own political take on capitalism, okay, but right now we're worried about trying to make you money. And capitalism is the number one way to do that. Okay, so what you're trying to say when you're talking fundamental analysis and technical analysis is, and this is for all my chart heads out there who like trading their own stocks, you keep doing it. You might get 30% today. You might get 30% tomorrow. Okay, but over a 10-year period, 95% of people cannot, even experts, the best of the best, the Michael Jordans of this world, cannot beat the stock market's average returns. Okay, that is insane to think about. All you have to do is play the game. All right, and what was that number we saw? It was 22 days was the drawdown time. Or hold on, let me read it. Sorry. Where is it? Oh yeah, okay. The market bottom typically takes 22 days with a recovery time of 47 days. That's on average. You guys can't wait 47 days for something? You can't wait 47 days? That is crazy. Okay, so the investment philosophy behind fundamental and technical analysis is that I would say technical analysis, for the most part, is short-term immediate gratification. Okay, and the fundamental analysis that we take, which is again why I think we have some of the best investment philosophy out there, is that for the most part, the average person, unless you have $3, $4, or $5 million, the average person just needs to be 70-80% S&P 500. Okay, now that's going to depend upon your time. If you've got 30 years versus 3 years, that's a different conversation. But just the general person, 70% S&P 500, you should have good individual equities. Okay, that is my feeling. That's my thought. If you have companies you believe in, a good company, for example, is Kava for us this year. Okay, I've been on Kava since January, or maybe it was February. Kava has, I don't even know what it's done on the year. All I can tell you is that when I looked at Kava, I said, this is like Chipotle. I was like, this is like Chipotle before Chipotle became Chipotle. And if any of you know Chipotle stock, it was once thousands of dollars. Okay, it's now since stock split and gone down, and still the same value, but just not as expensive of a share price. Well, Kava, let me look at it right now. It's at 126. So 1 year ago, well, we should do year to date, shouldn't we? So February 1st, it was $49. So now we're, what is that? 130%, 130%. That's a company I'm going to hold on to for hopefully a decade. Okay. Now I got lucky. Our clients got lucky. Whoever was in it at that time who listened to us got lucky. That usually doesn't happen. But when I looked at Kava, I didn't even look at any charts. I didn't look at their PE. I didn't look at any of that. The things that I looked at was, how do they handle their debt? Okay. Do they have a bunch of debt? Are they paying off their debt? Or, and then what's their goal? Okay. And then I went to Kava. I went to multiple Kavas and I tried the food. I got all of this investment, background ideas, how to evaluate a company from Peter Lynch, who I mentioned earlier. Okay. His thought process was, you're not going to beat the S&P 500, but you might be able to find 10 baggers. And that's the goal. That's what we're trying to do. Now, I have all day. I wake up at 4:30 before the stock market opens. You guys don't do that. Okay? You guys don't do that. And also, we're not putting in hundreds of thousands of dollars, right? Kava is probably not more than 1% of anybody's portfolio. So the way we do things, excuse me, is very different than the technical analysis investors. Okay, so I wanted to give you a little insight, and then just back to the events and the S&P 500, or the geopolitical events. Look, I can't tell you what's going to happen. Okay, all I know is that the amount of time, if I could save as an advisor, if people just said, hey, you know what, I'm going to let you handle it, and then I'm not even going to worry about my money. If I had $1 for the amount of time that I spent actually counseling people out of making bad, rash sale decisions, I would say I would be extremely wealthy, because I could just spend that time investing. But a lot of it is counseling people out of making these bad sale decisions. Don't sell. Don't sell. Okay, hold on. There's maybe 3 people, we probably have roughly 70 investment clients right now. There's probably 3 people who are in retirement. A majority of their stuff is in balanced portfolios that creates income. Okay, everybody else, they're invested in growth. And the idea is, we have 10, 20, 30 years. Ride the wave. Okay, find good companies. Learn how to create an analysis, right? A snapshot of a company that you like. Okay, Peter Lynch talks about finding boring companies. A boring company I really like right now is AT&T. I'll be honest. AT&T, I'm a huge fan. Put my own money in AT&T just a couple days ago. Now, I don't know what AT&T is going to do. All I know is that they're boring. They've been around forever, and they're one of the best phone companies. Okay? So I'm giving you guys some serious insight here in how we do stuff. But the big thing that we do is we don't react to events like this. Almost every client we have is prepared for a 40% crash right now. Every client. And what I mean by prepared is we have cash aside and we're ready to jump in. Okay. We're ready to jump in that market when we think that bottom is there. Okay. Remember what we said, 22 days to bottom out, 47 days to recover. Okay. So once those events happen, you just got to sit in and you got to wait. Okay. So again, on average, most people should just be in the S&P 500, and then they should probably have 10-15% cash. And then if you are actually spending time, okay, or hiring a professional, that is where the value of an advisor comes in, is picking equities and making sure your risk tolerance matches your entire portfolio. Okay. Yeah. And wartime, I hate to say it, but it's a time to make money. That's just how it is. Okay, so don't be fearful. When others are fearful, you be excited, and when others are excited, you be fearful. And okay, the other thing I wanted to say is I've said this in past episodes when the stock market's been really bad. Okay, I remember 3 years ago maybe, the stock market was at like 3,400. Okay, it's at 50. I think we're like 10 points away from all-time highs. It's at 57.51 right now. Okay, so 2 years ago, it was at 3,600. Okay, and what happened when that was happening and people were like, why is nothing happening? We're not making any money. I told them, I said, this too shall pass. Okay, this too shall pass. And now those people that said that, but listen to me, are killing it. Okay, that's a huge 3,600 to 5,750 is an insane amount in 2 years. Okay, it's insane. This too shall pass. So with the stock market doing really, really well, this too shall pass. There'll be another period of time where it's down. And you just have to remember that it's a ride. Okay, it is a journey, and it's only not a journey either when you die or when you get out of the stock market. Okay. One last thing. I know I'm over my time here. With the war in the Middle East, oil is going to be a really big contender in price fluctuations. Okay. I think something like 20%, 10 to 20% of our GDP is energy. Well, that's actually the core of our functioning economy. Okay. If it costs 50 cents more per gallon, then those trucks are going to have to send bread, right? Then those bread companies, to hire those trucks to move it, have to charge now proportionally 50% more or 50 cents more on the bread to be able to pay for the rising cost in oil. Okay. So at its fundamental core, energy affects every other market. So the second that oil gets regulated and gets calmed down and there's just a little bit more consistency in that market, inflation will drop. Okay. I promise you that. Energy is at the fundamental level one of the most important drivers of inflation, because if you can't afford to move it, then you can't afford to sell it. Okay, and you have to keep raising prices to be able to get that done. So that was the one thing I really wanted to talk about, other than the market, just 22 days to bottom, 47 days to recover, is that right now we have an inflationary period. Things are changing slowly. The second the wars get figured out in the Middle East and oil gets just evens out, calms down, inflation will drop. Okay. Guys, with that, this is probably my longest episode ever. I definitely went ranting today. Anyways, I hope you learned something. I hope you got some good insight on how we pick companies. I love it. That's one of my passions. I love getting up early in the morning and looking at these companies. Again, we're looking for 10 baggers. We're not looking to get something that's going to go up 10, 20% and sell it. That is a dangerous, dangerous game. And even amongst the professionals, I don't know a single successful person doing that. Okay. Guys, with that, have a great day. Invest early, invest often. We'll see you next week.